Sam said, I am with the Dell. I am with the Dell Home Realty Group, and I've been a real estate agent for a couple of years now, full time. And I have helped a ton of first-time home buyers, so I did make a couple of notes to be able to help you guys because most of the questions are the same when you're first getting into buying a house and just wanting to understand more about the process. So I'm definitely happy to go over everything today and answer any questions that you guys have. Sam, did you want me to actually get into everything now, or is this just an introduction?
You know what? Actually, if you could, that would be great. I think it will really help out with the transition into my end. And of course, throughout the presentation, there's something that comes up that relates to, you know, your field, your expertise. I'll ask you, and we'll just try to make this as engaging as possible. So I think Jeffrey mentioned we're going to also have, a chat available for questions, and then I'm going to periodically, look at those and answer those questions as they come in.
Did you want to use the screen sharing, or is Jessica using it? Are you the one using it, or how do you want us to do it? Because I see we have the screen right now.
I can operate it. It's fine.
Okay.
Okay.
So Jessica,
well, I guess we'll just dive right in. Yes. So we'll just start from the very, very beginning. I always tell all of my clients, when you're looking to buy a house, just because it is a mortgage and it is something that you're going to have for maybe the next 30 years, typically you'll own your house for maybe 5 to 10 years before you decide to sell it. But just making sure that you can actually afford it. And before you even go to a lender to get pre-approved, I always have my clients determine their budget and how much they can afford on a monthly basis, because having a mortgage is similar to renting, but there are other factors that go into it and it can be a little bit costly. So just being aware of how much you can actually afford is very important. And then it makes it really easy for me to help you find the house and be comfortable and making sure that you're not, spending more than you can actually afford to pay. So I always start out with a budget. We discuss a timeline. So a lot of questions that I get are in regards to how long does it take to actually buy the house until you actually get the keys and you can move in. And you basically can close on a property in 30 days. So if you go shopping in the first weekend, I have had home buyers love the first property and put in an offer and actually get it accepted, and they're closing in 30 days. So you can move in as little as 30 days. Oh, did we lose something? That threw me off.
Yeah, you continue.
Okay, sorry. But yeah, so that's the timeline. It takes about 30 days, but it can take longer. I would say anywhere from 30 days to even maybe 90 days. If you have particular things that you want in a house and just shopping for them, sometimes it can take a minute, especially when we're in the competitive market to where maybe your offer wasn't accepted the first or second time around. So after determining your budget and the timeline, maybe you have a lease that's coming up soon. I always tell people try to start shopping or speak with a realtor at least 3 months before your lease is up, just so that you know exactly, your pre-approval, making sure that you can actually get that done and you don't have anything that you need to work out first. And then figuring out, what location, what area you want to live in. The other things are determining your availability to actually go out and see the property. When you have a realtor like myself and you find, properties, they'll send you properties to look at online. But if you find something that aligns with your needs and your wants, then we can schedule a tour to actually go out and look at the property. And typically a tour can take anywhere from 15 minutes to 30 minutes. You're just taking a look with your naked eye. And then another really good question that I get is, how do you know if it's a good property or not? Once you find a property that you like, and I'll kind of go into like, okay. But yes, and let me know if I'm all over the place, but I do have some bullet points and I just want to make sure that I'm not skipping anything. So after the budget, you have your timeline and determining how long you need before you can actually purchase the house or before you need to move in. The next thing is determining your needs and your wants. So are you interested in living in a certain area? Are you looking in the city, in a county, St. Charles County, how far are you looking to live from your work, things like that. Those are questions that I'll ask. And then the next thing is like what to expect. So let's say you're wanting to buy a house in 3 months and you go ahead and get pre-approved, you have your pre-approval done, and we start looking for houses. You submit an offer because you like a house, you submit an offer and it gets accepted. I'll kind of go into what happens once you actually get under contract. And it's a really simple process, but it can seem like it's a lot going on. But do know that once you go under contract with the property, your realtor will be like side by side with you and making sure that you're on time with all of your deadlines. And some of those deadlines are your earnest money deposit. That's the first thing that's required when you find the property that you like and go under contract with the seller. You submit a deposit for the title company to hold while you're under contract. And ultimately, at the end of the closing, you'll get that money back and it will be applied towards your down payment and your closing costs, which I think that's something that Sam will touch on the pre-approval process. So I'll leave that part to him. But after you submit your earnest money, and typically that's due within 3 business days of actually getting your offer accepted. So once you submit that, the next step is to get inspections scheduled. And I do have a couple of different inspectors that I like to use. And I always let my clients know if you're interested in having your own inspector, as long as they're professional and they're actually certified, then they can conduct the inspection for you. But basically, we're looking for an inspection report, and they basically touch every inch of the house. They're looking on top of the roof. They're looking at your electrical system. They're looking at making sure things are up to code. Over time, things change. They're looking at the foundation and just looking at everything, your system, your air conditioning system. They're really looking a very deep look into the property before you completely decide to purchase it. And then if you find some things that you don't like, there are options to negotiate with the seller to either get the seller to pay for those things, or if they're not willing to help you, you can back out of the contract and continue your search. So that's a really big part of going under contract and finding a home is the inspection. You just never know what you're going to find until an inspector actually goes out and starts looking at things. I try to look whenever we're showing the property. If I get an inch that you're interested in the property, we'll do a deeper look, maybe look at the window sills to see if there's anything going on there, looking for cracks ourselves, anything that could help you figure if you want the property or not before you actually go under contract. Because one thing I do remind everyone is once you go under contract, you're paying your inspection money to get the house inspected. But if you decide to back out, you don't get your inspection money back. And I know that's important, especially, you have your down payment, your closing costs, and different costs that add up when you're looking to buy a house. So I know it's important to everyone, but inspections can vary from around $400 to about $1,200, depending on the type of inspections that you actually want to get for that property. And I won't dive deep into types of inspections, but some of the more simple ones are the building inspection, which covers from the roof all the way down to the foundation. Another one I like to have my clients get is a sewer lateral, just to make sure there's nothing blocking your sewer, which can be a costly thing. Something else, maybe a radon inspection. So if you have like allergies, you could get a mold inspection. So it really just depends on the specific person and their needs and things that will worry them. But I always tell my clients, do get an inspection. Never waive your right to actually inspect the property, because you just never know what you might find. And I can go into the next couple of steps and making sure you're getting insurance. That's a part of the, the lending side, is making sure that you're getting insurance to cover the property and making sure that the property is actually insurable. After you take care of the inspection and the insurance, the next thing is to work with your lender. So a lot of what happens after inspection and insurance is working with your lender, getting them over all the documents, that they need in order to approve you or give you a final approval before your closing day. But once everything is worked out, we do go back out to the property a couple of days before you close on it, just to make sure that the seller hasn't done anything crazy or the property isn't in a different condition than it was when you first saw it. So that will be your final walkthrough. And then we pretty much sign off on that to say the property is in the same condition, or if something's wrong, then that's something that your realtor will work through with the listing agent and the seller. And then the last thing, which is the most fun thing, is the closing day. This is the day when you actually get your keys to your property, and based on the conditions that we write in the contract, you actually have the ability to move in your property the same day of closing. So it's really that simple. And it all happens so fast once you go under contract. But I always tell everyone to go back to the beginning, make sure that you know exactly what you're looking for. And it doesn't have to be exact down to the T, but knowing what location you want to live in, whether you have kids, what school district that you would like to live in. A lot of people are concerned about moving into safe neighborhoods. So there's, tools that I can provide to help you determine if it is a safe neighborhood, or if the school district is, a highly rated school district. So, and also determining your budget. That's the biggest part, is making sure that you can actually afford to buy a house. But I think that pretty much sums up the whole process of buying a house outside of getting pre-approved. Does anyone have any questions about anything I said? I know I went over a lot. Or did we have any questions in the chat? Let me check. No?
Not yet.
Okay. I feel like that's it.
Hey, Jess.
Dan, was there anything I left out that you think I should add in?
Well, I was going to ask you actually. I know you mentioned the importance of having an inspection and not waiving that. I was going to also mention, as far as in the contract for that real estate transaction, is there any other piece of advice you would recommend when it comes to maybe contingencies and how important those contingencies are in protecting the buyer? Is there anything that?
Absolutely. Let me see.
I mean, obviously
there is a contingency. The appraisal contingency is a really big one. So the inspection is a part of the contract. Yeah, you're right about that. But the appraisal contingency, or the appraisal writer that we add, that's an important one. And it's like an automatic thing for me, unless it's a lot of competition for the specific property that you're interested in, and we're wanting to be a little bit more competitive. But I always explain to my clients, if you don't add an appraisal contingency or an appraisal writer, you run the risk of, oh my God, it's an echo, sorry. But you run the risk of the property not appraising for the purchase price. And if that does happen, then you would potentially have to come out of pocket for the difference. So for an example, if you write a contract for a property at $400,000 and you choose not to include that appraisal writer, if the property comes back and it's appraised at $395,000, you might come out of pocket for the difference of the $5,000, or you could try to negotiate with the seller to help you cover a portion of the difference. But that is something that I automatically always add to the contract. And when you add it, it basically says, if the property appraises for less than the purchase price, then basically the buyer has the ability to back out of the contract if the seller does not reduce the price down to, the appraisal value. But other than that, the other, contingencies that are added, it really depends. Like if you are trying to purchase a condo, we'll add different contingencies. Because I know there's different restrictions at different HOAs for the condos, and a lot of people might have like pets or just want to do something different with the property, and maybe there's restrictions and you want to find out about that. So that's something that I would add. And a lot of these are like kind of case by case. So I always go over all the options with all of my clients, just because properties can be different and it's different for each property. But I'm trying to think, are there more contingencies that I could add? I think the appraisal is the biggest one.
Yeah, I think the appraisal one, of course, the financing contingency are really important. Another reason why I ask is because I've seen on my end situations where, a lot of times buyers don't understand these contracts are built in a way to really essentially protect them. It's a legal contract. You will make sure that you fully understand what you're getting yourself into. So things like you said, waiving that appraisal contingency. I've seen people waive financing contingency even though they're getting a loan, which doesn't make sense. So, if you waive those contingencies and something falls through, then there's the opportunity of you maybe losing your earnest money. or even potentially get sued. So I think those are very important points. But you mentioned, you went over a lot of, very informational details about your job. And I think that was very helpful. So again, I just want to thank everyone for joining this. You're done, Jess, right? Just want to make sure. I know there's a lot more that your job entails.
No, I was just going to add to what you were saying about the importance of like the contract. It is designed, like if you read through the contract, it is designed to protect the buyer, and it basically gives you a certain window to back out of the contract if something isn't going wrong. But it is important to have an agent that is on top of the deadlines, because if you do miss a deadline and you decide you want to back out, let's say inspections, for example, if you go under contract, you do your inspections and you only have 10 days to decide on.
It's me.
Oh, sorry.
Hold your horses, sir.
Hey, oh, there we go. Hey, Jess, I think you're muted.
Okay, I think it like automatically muted me, but I was just saying it's important to have a realtor that's on top of the deadlines and that has a process to help you make sure that you have enough time to make a decision and actually help walk you through that. I think that's super important for first-time home buyers, because you really don't completely understand what you're getting yourself into until you actually get under contract and you're going over everything with your realtor, which is understandable, especially buying a house for the first time. But that's all I wanted to add is, it is important to get you a good realtor that stays on top of the deadlines and knows how to write a good contract to protect you. So, but that's pretty much it.
Awesome. Well, Jess, I appreciate that. And, throughout this presentation, if something comes up that you want to maybe add to, definitely let me know. I'm sure there's going to be certain parts that intersect. Because obviously we work closely together to make sure our buyers and borrowers, get keys to the house that they want. So, yeah, thanks for that. Yes. So the one thing, obviously this is going to be, for the most part, maybe the largest financial investment that most people make. So this is a very important topic, and we want to make sure that you walk away, from this workshop with very valuable information that can help you make the right decisions and that can prepare you to purchase a home. Now, this is going to be basically the 10,000 feet overview of basically, home ownership and how to get ready. So, of course, feel free to ask any additional questions. Jess and I are going to leave our contact information if you want to reach out. I do highly encourage that you guys, if you are interested in buying, relatively soon, within the next maybe few months or even the next year or so, reach out to us, have a quick 15, maybe 20-minute conversation to find out, what kind of things we need to put into place to get you ready and prepared to buy. The two things that I really want to basically hit on in this workshop is basically the reasons why most people don't feel that they're ready to buy a house. And usually those reasons are either credit worthiness or maybe a lack of resources and down payment and closing costs. So those are usually the issues that most people are going to run into and being able to purchase a house. So Jess handles all the fun stuff, right? Being able to help you find the perfect, wonderful home of your dreams, your forever home, maybe your house that you may turn into an investment within the next couple of years. It's my job to make sure that you can actually afford to make those payments. And it's my job to help you get the financing to purchase that home, unless you just happen to have, $200,000, $300,000 just laying around. Most people don't have that kind of cash. So they're going to, end up talking to me in order to find financing. So, so we're going to really touch on really those 2 points. So really the first, and I did add, let me know if it's in chat, but I added the guide so you guys can follow along. And I also added a budget worksheet. So just kind of mentioned going over a budget. It is really important to really make sure that you can make affordable payments. We're going to touch on something called debt to income ratio. So that's a ratio that we use on the lending side to make sure that you basically can afford your payments. It is pretty conservative. They make changes to it all the time. But the one thing that we don't consider is all your additional payments that don't show up on credit. So what we look at is all of your credit limits or all of your credit lines. So your credit cards, your personal loans, your car loans, your student loans. So anything that basically shows up on credit is what we're using to factor in that ratio. Now, things like your groceries, your utilities, or any additional payments that you make, we're not going to include those payments. So that's why it's important to make sure you are going over the budget, to make sure that you personally are incorporating those additional payments, because you want to be able to comfortably afford a payment. And this is a conversation I've had with Jess as well. Sometimes when buyers come to us and we pre-approve them, we try to give them a little bit of flexibility on that payment, because we understand there are going to be things that come up. We do understand that, if they have a family, they've got to feed them, they've got to pay for utilities, they've got to get clothing, all these additional things that we're not necessarily looking at. So that's definitely a touch point that I mentioned, is to make sure that you are leaving some flexibility in your budget. So I'm going to move over to, and let me know, guys, are those attachments in the chat? Thumbs up, maybe.
I was able to
Yes.
see it, but
I think, yeah, when you click it, it's able to open it up. I've opened the 3 of them. I see the first time honors and background check. Yeah, it's opening up.
Perfect.
For some reason, I didn't see them.
You can post it again.
I see the first 3.
Okay.
Okay. Yeah. Okay. Now I see it. Okay.
Perfect. Yeah. So feel free to open those attachments and follow along. And some of them are going to be just more so as a resource, like the budget checklist. We're not going to necessarily go over those or over that sheet, but yeah, take that with you. Look at your budget, look at all of your expenses, and that's going to really help you figure out, what you can afford monthly on your mortgage payment. So the biggest question we get is, the pros and cons of buying or renting. And Jess, feel free to pitch in. So it's one of those things where it really comes down to the individual. You can't necessarily compare it apples to apples. There are pros and cons to really either direction. From my perspective, the biggest thing to look at is, like I mentioned before, this is going to be one of your biggest financial investments, right? So if you have a home, it's considered an asset, right? And you can even look at it as your own personal bank, because down the road, once it continues to build in appreciation, which is typically about 3 to 5% per year on average. And actually, these past couple of years, it's been a little higher because of all the craziness that's been going on in the market and inflation, and really just the demand and the lack of inventory and housing really increasing prices of homes. So that's drastically, for a lot of people, increased their value. So just having an asset that you can pass on to your kids, your grandchildren, or even pull from as cash down the road in equity, that's one of the biggest benefits from my perspective of owning a home. And those monthly payments you make on your mortgage, they go towards you building more equity. If you have an apartment that you rent, or if you're renting, those payments basically go towards someone else's pockets. You're paying someone else's mortgage rather than paying your own mortgage. Now, looking at this sheet here, there are some advantages to renting. For some people, maybe they know they have to relocate in, the next year or so. They may not want a long-term investment such as owning a home, because, regardless of whether or not you live in the state that you own your home, you're still making payments on that house. So a lot of times you have to end up maybe renting it out in order to make your payments, or now you have an additional cost. So that could be a disadvantage of maybe owning a home rather than renting. But for the most part, in my opinion, it's a lot more advantageous and favorable for you to own a home rather than to rent. So again, there's going to be tax implications for owning a home. You can kind of write off some of your interest expenses on your mortgage payments. So there is going to be less flexibility to move, of course, because now you have a house that's there and it's fixed. You don't have a landlord. You do have more flexibility as far as maybe personalizing your home. You can paint it. You don't have to get permission. You can maybe swap out appliances. You can knock down a wall. These are things that you can't typically do if you're renting. And I mean, for the most part, or maybe say you have thin walls, right? Maybe you have, your neighbors in your apartment that you don't want to necessarily deal with. Maybe they have a lot of kids. But then again, with an apartment, you may have amenities, right? You may have a gym, you may have a swimming pool. These are things that you have to consider on, what makes more sense for you. So again, it isn't an apple to apple comparison. It really just comes down to the individual. If you're looking for a long-term investment that you can pass on, I do believe owning a home is probably your best route, because you are, in my opinion, throwing money away when you're renting. So I don't know, Jesse, you wanted to add anything else to that?
Yes, I do. So what I want to touch on is just to explain it a little more clearly, because some people don't understand equity and how that actually works. I was actually looking at that. I was going to use that.
Yeah. Oh, you want me to? Yeah. So equity is basically.
Go back. I think he wanted you to go back to the other slide.
Yeah.
Oh, yeah.
Thank you, Jeffrey.
Yeah. So
I was just gonna explain it from my perspective. When it just comparing buying to renting, I know when I was renting, I really didn't understand the purpose of buying, because it seemed easier to rent. Like you said, it's flexible. I can leave when I want to. But buying is more of a financial decision, and it's an investment. And I kind of just wanted to explain how the equity actually works. So when you're paying your rent on a monthly basis, you're paying someone, and this is just money. It's just an expense. It's money you will never see again. You will never get money back from it. When your lease expires and you decide to move, you don't get any money. You just give your landlord their keys. But when you buy a house, like Sam was saying, a part of that payment actually goes towards your principal, and you're paying down the amount that you owe on the loan. And both renting and buying property. So properties, I can't think of the word.
They appreciate.
Growing. They appreciate. Yes,
Yeah.
Thank you. They appreciate over time. Rent increases, as you guys, I don't know if anyone else has noticed, but rent's really expensive, but homes appreciate also. So when you lock in a property and you're paying on it, you actually get it for a certain rate, and then you're paying it down. So the way that the equity works is you're paying down your mortgage, but your property is actually growing in value. So maybe in 10 years, it's going to be worth so much more than it was when you bought it. And you'll be able to sell it and get some of that money back. And that'll help you, for your next place if you want to build a home. And that's why I don't know if you guys have heard, but I have heard that your first home will not be your dream home. It's more of an investment to set you up. And then later, when you sell your property and maybe you need to buy a bigger property or you need to downsize, you'll actually get a lot of that money back when you close on your property, versus renting where you don't receive any funds when you're done. So I just wanted to touch on that and explain a little bit of how the equity works, because I know a lot of people don't really understand how equity works. And I don't even know if I explained that clearly enough. Did that make sense to you?
Yeah, it did. So I think that's very important. And we're going to actually go over how your mortgage payment is structured. So we're going to go over your, it's called PITI. So it's your principal, interest, your taxes, and insurance. And we're going to also go over your amortization schedule. And that kind of shows you the breakdown of that difference in equity. So basically, equity is just the difference between basically what your house is worth and what you owe, right? So if your house is worth, let's say, $300,000, and you have a balance of $200,000 on your current mortgage, right? That means you have $100,000 in equity in that property that you could potentially tap into. Or let's say if you sell it, you're making $100,000 profit, right? And there's a lot of people right now where they're doing basically, it's called a home equity. There's a line of credit, or they might even do a cash out refinance where it allows them to actually tap into that equity. And there's people that have used that equity to maybe start a business, or maybe they use that to maybe fund another purchase of a property as a down payment. This is money that is, again, you can look at your home as basically your own personal bank. You're not going to most likely have, unless you're really great in saving, that kind of money just laying around. So it's a really great opportunity to have equity in your home. And every time you make a monthly payment, you're increasing that equity, because now you're paying down the principal, which is your current balance. And so it's lowering your principal, and your value is the most likely to stay the same. It does creep up slowly yearly, but the more of a gap you have between the equity versus the balance. So usually more equity, less of a balance every time you make a payment. And when you're making a payment towards rent, you don't see any equity. Because again, that property is not a property that you own. You're literally just throwing money away. So again, for some people it makes sense to rent, but again, I think it is very, if you can afford to buy, it does make sense to own property. Do we have any questions on that? If I can, I'm going to try to see if I can pull up maybe an amortization schedule to show you guys what that looks like. But we can touch on that a little later on this presentation. But yeah, do we have any questions on that?
I saw a question in the chat, but I think you touched on it. It said, can you take equity out of your house before you sell it? And the answer is absolutely.
Yeah. Yep. You know, that might reduce the proceeds you get from your sale, but you've already pulled that money out anyway. So yeah, so long as you have equity, you can pull it out for sure. Now this is where it gets a little bit more in depth. Most lenders are not going to always give you 100% of that equity, just from a risk factor. So if your house is worth $300,000, we're not going to give you that full $300,000 because we just don't know. The market is so unpredictable. We just don't know what may happen. Values can also decrease. Now, typically they do increase, but just from a risk factor, you're probably going to be looking at maybe 80 to 90% of that loan of value that you can pull out of that equity, if that kind of makes sense. So out of 100,000, you're probably looking at closer to maybe 80 or 90,000 you tap into, rather than that full 100%. But that's when it gets a little bit more in depth. But your actual equity
I
is.
feel like,
Go ahead, Jess.
no, I was just gonna say, I think that's a level of protection for the buyer as well. You don't want to take out all of your equity in your property, you know, just in case anything in life happens, hardships where you might actually be forced to sell it. You want to make sure that you aren't upside down on your mortgage.
Mm-hmm.
So I think it's a good thing that you can't take it all out.
Absolutely. All right. So do we have more questions on whether or not to buy or to rent? No? Okay. So typically once you have a conversation with me, you want to get pre-approved. What we look at is whether or not you qualify. And the way we look at it is, again, the biggest factor we mentioned before was that debt to income ratio in your credit. So in order for us to figure out what your debt to income ratio is, we need to calculate your income. And depending on how you receive your income, that kind of tells us what kind of documents we need to gather. So if you're self-employed, for the most part, we're probably going to collect 2 years of tax returns. We may need business tax returns as well, depending on how your business is structured. If you're, an independent contractor, we need 2 years of 1099s. For the most part, most people are going to be salaried or hourly. And at that point, if you're a W-2 wage earner, we just need 2 years of W-2s and 2 of your most recent pay stubs to calculate your income. And what we're also looking at, just to make sure we're clear, is your gross income. So, before taxes are taken out. So that usually is a lot more favorable in what you qualify for. And that kind of goes back to the question of your budget. So if we're using the income of your gross income, you're not taking all that money home. You have taxes taken out of your pay stubs. So that's also something that you need to consider. I think got a couple people there on mute. Oh, there we go. So this just has a list of these standard documents. Again, basically 2 years of tax returns, 2 years of W-2s. And when we're asking about 2 years, so for the most part, we are going to need basically 2 years of work history. Now, definitely have a conversation with a mortgage lender before you automatically, talk yourself out of maybe getting pre-approved. Because a lot of times you'll have maybe students that recently graduated and have only been working for, let's say, a few months, or let's say a year. So they're under that 2-year threshold. But what we're looking at really is we can make an exception in that scenario. So basically it's 2 years of work history, which also includes any type of schooling, right? So if you get out of school, you just recently graduated, you're an engineer, and all of a sudden, you found a job at Boeing as an engineer. you will still qualify and you'll still fit under that 2-year work history. So we can still, help you in getting pre-approved. So I just wanted to throw that out there as a side note. All right. So look at is, at least for my lender, is at least the minimum credit score of a 620 or above. If you don't have a 620, what we don't like to do is ever tell people, no, we can't help you. If you need a little bit of help on credit, we're here to help and support you with that. So we have different programs on our banking side that can help you in building that credit. We have different partners that we work with in helping you maybe rebuild your credit or establish credit. But for the most part, you're looking at maybe a 620 to a 640 credit score to really get you pre-approved. So on here, it does show for debts. When we talk about debt to income ratio, for the most part, you're going to want to be, now it does depend on the type of loan program you get, but you are going to want to be basically under 45% debt to income ratio. This says 38%. And that's very conservative. I mean, that's a really healthy percentage rate, but typically we're looking at about 45% under. If you end up going FHA, we can go all the way up to 55% DTI. So, depending on your situation, we'll find the best, loan program for you to help you get qualified. And like we mentioned before, with the employment history, we are looking for basically a 2-year work history. And it doesn't have to be, another side note, it doesn't have to be with the same employer, right? So if you're like with me, let's say I've been in banking with a different bank for, let's say, a year, and then I move to a different bank and I'm doing the same type of job for another year, that still qualifies for that 2-year work history. So long as you've been doing a similar job in the same field for 2 years, that's what we're looking at. It doesn't necessarily have to be with that same employer. And then the other thing we're going to touch on is your down payment. Very important is we want to make sure, for the most part, you're not going to find lenders that do 100% financing. We do want to make sure you are basically also invested in purchasing that house as we are in lending you money, because we kind of, the term we use is we want to see that you have skin in the game. How invested are you in making this purchase, right? So we know that you put money down. We know for the most part, you're going to most likely make your payments because you put your own personal investment in purchasing that home. So for the most part, you're looking at least for first-time home buyers, a 3% down payment, about 3 to 3.5%, depending on the loan program that you go with. If you're not a first-time home buyer, you're most likely looking at 5% down payment. So just wanted to throw that out there. And the down payment is basically a percentage amount of the purchase price. There are other fees. Well, the down payment isn't necessarily a fee, but there are fees called closing costs. So these are all the other fees associated with buying a house. So you're going to have to get the house appraised. We're going to have title documents to make sure there aren't any liens on the property, and to properly move, the vesting from the previous owner to your name. So there are additional fees that are incorporated into basically your closing costs and down payment. Overall, we'd like to use a thumb rule of about 3 to 6% overall is what it's going to cost you to purchase that home. Any questions, guys?
So you're looking at, I guess, 3.5% for down payment minimum, and then, or I guess 3% if you do a conventional, and then
Yep.
Closing costs are about 3% as well.
Pretty much. So conventional, and we can go into the different loan programs. The two most popular are going to be your conventional mortgage and your FHA mortgage. So your conventional mortgage is going to give you essentially your best terms. So you're going to most likely get, the best rate on a conventional mortgage. So these are the individuals that banks really, seek after: individuals that have great credit, individuals that have good income, healthy debt to income ratios, a healthy down payment. You're going to most likely fit into that conventional mortgage bucket, to say. And that one is going to have essentially the best terms. And it does have, again, 3% down payment minimum for first-time home buyers. FHA is also another great program, which does have fantastic rates. And they're also a little bit more flexible on the individuals that qualify for it. But that one has a down payment requirement of at least 3.5%. So, and we actually do have a program here that is a 100% program. So, you know, if maybe you're a little cash strapped, we can't help you in getting 100% financing on that purchase price. And the only thing we cover is that additional, basically 2 to 3% and your closing costs. So all the other fees associated in that purchase. Now, the question is, where do you get your down payment funds from? So you can get money from family, and we like to call those gift funds. I'm going to actually pull up something here. Could be helpful. All right. So there are a number of different ways to get down payment funds. You know, obviously the most obvious is having money saved up in your checking or savings that you've set aside for, you know, purchasing the house. But again, there are other ways you can get funds. And we have to certify that those funds are gifts. So we actually have to have, we've got to have the,
Hello.
Hey, Moses.
There
we go. Yeah, so gift funds, basically the way that we, you know, have to make sure that those are certified funds is, or not certified funds, but those are truly gift funds, is we have the donor basically fill out a gift letter, basically stating that, hey, I am giving, you know, my daughter, my son, funds to purchase a home, and it's not required to be repaid. We don't want to see any type of large deposits from your checking or savings account that we can't trace, right? Because at that point, it may look as if it's a maybe undisclosed debt that you've got to repay. And when we're trying to figure out, you know, the risk of providing a loan for you, we need to know all of the debts that you have, all the other obligations that you have to make, because that helps us in really, you know, figuring out if you actually truly qualify to make a mortgage payment. So, yeah, gift funds are totally acceptable. It just has to be basically pretty much signed off by the donor, stating that, you know, it's truly a gift that does not have to be repaid. There's pledged assets, so again, cash in your savings, checkings. And just so you guys know, we can't ever use just cash. I know it says cash there, but cash in a real estate transaction, everything has to have a paper trail. So that just means funds in your checking your savings. You can also pull from like retirement accounts, you know, 401ks, you know, anything that is essentially funds that you have set aside for yourself, you know, whether it's funds in a fluid checking savings or maybe a retirement account. There are seller concessions, and Jess, feel free to chime in on this. But that's essentially when the seller decides to help you with the purchase by giving you some, basically we call it seller credits or seller concessions, which we basically apply as a credit towards the total purchase amount. And there's also housing grants. So this is something you're going to really want to have a conversation with us about. There's changes all the time. We also have to make sure that you qualify for it. A lot of times they are kind of geared towards more of the lower to moderate income individuals. So they may have basically income caps. So not everyone necessarily qualifies for them, but a lot of times there are a lot of great grants out there that will help you with your closing costs. And it's pretty much a forgivable loan, so you don't have to repay it, but they do have their own terms as far as in those grants. So these are just some ideas on ways to get those funds. So kind of like what Jess was saying earlier with, you know, sitting down, even like, let's say your lease on your apartment's getting ready to come due. You know, it's something that I think is worth, you know, having a conversation even as early as a year before you move out, because you want to make sure you do have money set aside for your closing costs and down payment, because that is one of the things that usually prevents people from buying a house, because they just don't have any money set aside for their closing costs. All right, so within the real estate transaction, there are a ton of different individuals that are a part of the process, essentially. And these are just, well, this is pretty much the bulk of the people that are involved. So you're gonna have your appraiser. So that's gonna be the individual that basically gets the fair value market of the house that you're wanting to buy. So they'll actually go out there and they'll assess it and make sure that it is truly worth what the seller is basically listing it for, hopefully. You've got your closing or settlement, basically title, your title agent. These are the individuals here, at least in Missouri, we have title. Some states have attorneys that actually go read closing documents and basically make sure that everything is recorded properly with the county that you're in, while purchasing that property. Make sure that the true ownership, the legal ownership, transfers over correctly to your name. Of course, you have people like myself, the loan officer. So these are the people that individuals that represent the bank that basically helps you get financing for your mortgage. So we're going to essentially help you find the best program for yourself, get you the best rate. And then you have the loan servicer, which is basically the bank. So the bank that's going to actually hold the mortgage, this is who you're going to make your payment to. So, whether it be us, Wells Fargo, Bank of America, that's who you're making your monthly mortgage payment to. So they service your loan. You've got your mortgage insurer or mortgage insurance, not to be confused with homeowners insurance. Mortgage insurance basically just, to keep it very, very plain, protects the bank. Protects the bank's money if there were to be any type of longstanding hardship with the borrower to where maybe we have to go to foreclosure. So this helps protect the bank and their money and their investment in that loan. Now, typically with mortgage insurance, the only way to get that waived is if you put down 20%. So you put down a 20% down payment, that would waive the additional cost of mortgage insurance. And then it also depends on the actual monthly cost of it, depends on your credit worthiness. There's a few different factors that go into figuring out how much that actually costs for you. So it's your credit, it's how much of a down payment you put down. It's, they're looking at how strong of a borrower you are, and the stronger you are, typically, the lower your mortgage insurance is. You've got your property inspector. So they're going to go and examine the house and make sure the house is basically in good condition, and there aren't any issues that need to be addressed. And then of course you got your real estate agent. So Jess is a real estate agent, so she's going to be the individual that helps you find that wonderful home that fits your dreams, and basically she's going to also help you come up with the best offer and get the best contract. So you definitely want to make sure you have a wonderful partnership between basically your bank and the real estate agent, and putting you in the right product and getting you the best deal.
Can I add something really quick?
Absolutely. I want
to. A really good question on the real estate part. A lot of buyers, especially first-time home buyers, are curious, how do you pay for a real estate agent? And I love to touch on this one because it's not a part of like your closing costs or anything. The seller always pays the commission for the real estate agent. So, and it's pretty much like a requirement for you to have a real estate agent. So it's at no cost to you. There may be about a $390, like a lower transaction fee that you're charged during, and that's a part of your closing cost. So it may range from $300 to $500, but the commission's paid by the seller of the property that you purchased. So that's just not a buyer's closing cost or a fee for the buyer. So I know that's a question that I get a lot. And I actually wondered that before I became a real estate agent and I bought my house. Should we use a real estate agent? You really can't see any properties without a real estate agent. You need to have an agent actually allow you to access the properties so that you can tour them. So you definitely need a real estate agent, and it's really at little to no cost to you. So I just know that's a question I get a lot, so I wanted to jump in, but that's it.
Yeah, and even when it comes to like private sales, I think it's very important to still have, an agent involved or an attorney, just to make sure you're getting into the best contract. They're going to make sure, again, first of all, you're getting the best price, right? Because they're going to do their comps or comparisons of, similar homes, and they're also going to make sure that you're not getting into a bad deal. That's a legal contract, and owning that house it's a long-term obligation. So you want to make sure that you have someone that's on your side to take care of you and to make sure you're protected. So very, very important.
Hey, Sam, it's Elisa. Can you hear me?
I can. What's up, Elisa?
Hey, hey, everybody. I'm going to jump off the call, but before I do, I just want to share some things. I was listening to the call, and I've actually taken someone to the closing table that was on one of these meetings with who what is it, Nintendo for Africa. So we're going to get you to the closing table as a first-time home buyer or an investor. But I want to piggyback off some things that both Jessica and Sam said before I get off. So some things that could happen during the transaction. So and I'll be like less than 5 minutes. So anyway, let's go back to the real estate transaction. When you find your real estate agent and she asks you hey, let's get this earnest money. You got your contract signed for the property. Let's get your earnest money. A lot of things, a lot of issues that are coming up is the way that the earnest money is produced. So write this down, watch this, because a lot of people don't have a lot of savings. So pull your earnest money deposit out of your bank account by money order or by cashier's check, because like Sam said, everything needs a paper trail. And the reason I say that this is very imperative, and if there are any other real estate agents on there, share this with your clients, because during the loan process, there are numbers, and your earnest money could be a part of your closing at the beginning or at the end. Now, if a lot of people don't have a lot of savings, so we include that, we minus that as a part of your down payment money if we can source where it came from. If you take cash, if you do not source it, meaning if you don't pull it out of your bank account, then you're going to end up having to have more money in the bank to close on your house. But we can deduct that, which will help a lot of people who don't have a lot of savings. So get in the practice of, if you are buying a house, make sure you have enough earnest money in your bank account. Do not pull cash out. Go to Quick Trip or go to Walmart and get a money order, because you won't get credit for that at the beginning, and you may have to replace that money for reserve. So that's one thing that's very, very extremely important. Create that paper trail right there. Get that money right out of your bank account. Earn from your bank money order or cashier's check. Secondly, I just want to touch on the way you bank. Like Sam said, we're going to ask you for 2 months of personal bank statements. If you own a business, we're going to ask you for 2 months personal, and then 3 months bank statements. Watch how you bank. Don't put large money like cash out your drawer, or I've been saving money at home, or my boyfriend got me this, or my grandma gave me this. It happens, and that can cause your loan to collapse. These are bad pre-banking habits that you can eliminate by just having your money in the bank. If you're putting cash in there, if you're a hairstylist, a makeup artist, or whatever, that's fine, but it got to be routine. You can't just put $1,000 in, or even 500, and not know where it come from. The bank won't let you use that money. Okay, so be very, very careful with your banking, with your business. Also, your deposit, your closing cost money. If you own a business and you keep all your personal money in your business account, you are not using that money to go to closing to buy a house, okay? Unless your accountant gives you approval to do so. And sometimes that don't work out too well. So make sure your money is in your personal bank account. Your taxes, if you are self-employed, do not let anybody in them, and I mean like your cousins and friends, and they just say they do taxes. And this is real important, because we're going to dissect these. We're going to underwrite these documents. Even if you have a contract, after the contract, these are the things that are going to go on. The underwriter is going to look at your tax papers to see, even if you're a wage earner, and some people put fake businesses on their tax returns. Don't do none of that kind of stuff. If you think you want to buy a house, all of those things can affect you. Schedule C, write this down. Schedule C is what we're looking at if you're self-employed, or if you work for someone and you have a business. Schedule C, line 31 cannot be in the negative. Just gonna touch on that. It has to be in a positive. If it's a negative, your business ain't made no money. You won't qualify for the loan. Okay, and then unnecessary purchases. Don't go buy a car and you're ready to buy a house. Don't buy that $800 car note and you want a $1,500 house note, and part of that $800 car note is your house note, and then you don't qualify for debt to income. So be mindful of what you are deciding to buy. I always tell people this, my clients this, have more house debt versus consumer debt. Let the house debt pay for your consumer debt. So the people with the prettiest credit reports is what I say are the people with the least amount of trade lines, the least amount of credit cards, the least amount of cars. I mean, all of those little things are factored into your loan structure for us to get you to the closing table. Don't go buy any furniture. We're going to see everything. And if you have real estate property that's in your name already, we're gonna use all of that debt against you. So a lot of people run to these auctions and buy 2 and 3 and 4 houses, but then their regular income can't support a regular loan because now we have to add all the taxes and insurance from these other properties into your debt to income. So be mindful of what you're buying, get a game plan, and just do your banking right. Every transaction is watched from the time you get that sales contract into the bank prior to 2 months before you get that sales contract. We're digging back deep 2 months prior. So watch 2 to 3 months. So watch what you do. If you want to get to the closing table, it is fun. Just follow Sam's lead and Jessica's lead and just pay attention to exactly what I said. Our loans go to the closing table, but there do be issues. Don't get me wrong. They are fixable, but you can cause yourself less stress by doing all of these habits ahead of the game. I'm telling you, you don't want to get in the middle of your loan and say, oh, this is too stressful. Somebody should have told me. Well, we telling you today. That's why Sam is having this class. Let's get everybody to the closing table 1, 2, 3, 4, 5 times. just get in the habit of doing things right. And I gotta go, Sam. Bye, y'all.
That was great. Bye.
Thank you. Lisa, that is powerful.
Thank you.
Bye-bye.
Yeah, that was definitely very important. It's very true. And it's so unfortunate when you go under contract, you know, if it falls apart because of something you've done, you know, so.
Yeah, no, absolutely. So, yeah, those are some things that, you know, you definitely want to be cognizant of before you start the process. So, like she said before, with the tax returns, and this is, again, maybe a little bit more detailed than we wanted to go into maybe today. But yeah, so if you're a business owner, and this happens a lot, there are a lot of business owners that write off essentially everything, which is great for you individually on your tax returns and the tax liability. But when it comes to trying to, you know, apply for any type of loan, really, you know, you're now in the negative, or you have essentially barely any income. So when we're using your business tax returns, and like she said, like on Schedule C, so if you're maybe a sole prop, or if you're a single member LLC, so you're going to have Schedule C. You know, if you're a corporation, you're going to have your actual business tax returns. So that shows as a negative income. We actually have to count that against you as negative income. So now you basically qualify for nothing. So that's something to consider. If you, again, like you mentioned, if you own other properties, we're looking at those additional, you know, debt obligations, and that includes taxes and insurance on those individual properties, as well as if you have any outstanding mortgages on those properties. Everything gets counted against you as the individual applying for that mortgage. The only other way to get around some of the transactions in your accounts is to pre-plan. So we're going back to 2 to 3 months. So anything before that we consider seasoned, right? So like Jess was saying before, we really want to make sure you have a game plan to make sure you're prepared to buy. So if you had a large deposit, so long as it happened, you know, 3 or 4 months ago, we're not going to see it. So it's not something that we're going to want to necessarily source. You know, anything within that 2 to 3 months before applying for, before receiving the contract, we're fine combing through your statements. So we're going to ask you about every transaction that's out of the ordinary. So it's not like your income. We're going to basically we're going to want to figure out what that is. And there is a certain percentage for most, well, depending on the type of loan program you get, which is basically anything over 50% of your income. We're going to want to know what that is. So we can't source it. That could really hinder you qualifying for the loan. Or we may not allow you to use that as part of your down payment for closing costs. So definitely things that you wanna know. And to be completely honest with you guys, I think it's very important that we have these classes because for the most part, I don't know about you, Jess, but for me, I'd say maybe 2 out of 10 transactions go smoothly, which is, I mean, only 20%. And the rest of them, something always comes up. There's always an issue that could have been addressed if they would have planned beforehand that, we wouldn't have to deal with during the contract phase. So it's very important that you do pre-plan, hopefully several months before you buy a house, to make sure you are fully prepared and you don't have any roadblocks, during the process of it. Okay, well, I don't know if you guys have any questions in regards to what Elisa had mentioned. And by the way, Elisa is one of my colleagues. So I'm definitely thankful that she had a chance to hop on and support. But yeah, feel free to ask any questions in regards to what she mentioned in chat, and I can address those as well, which I think there are some questions.
I think Evelyn has raised her hand. Maybe you can give she may have a question.
Oh yeah, I noticed that, but I didn't even register for me to ask. So yeah, Evelyn, what question do you have? And you're still on mute, just in case.
Yes, I don't know. Maybe.
Yeah. Well, we'll circle back. All right. So moving forward. So the amortization, like we mentioned earlier, basically once you go to closing and you get your closing documents, you're going to get a sheet that basically shows you the breakdown of all of your payments until that loan is basically terminated. So your full 30 years, you can see what those payments look like. It's going to actually show you how much of your payment goes towards your principal and how much of it goes towards the interest. In the very early stages of your loan, the majority of your payment is going to go towards, I don't want to say majority, but a lot of it is going to go towards your interest. And the further down you go, you're going to have more of your interest, more of your principal paid rather than interest. Basic math, the larger the loan amount compared to your rate, the more of it is going to be eaten up by interest. The annual percentage rate is a little different from your actual interest rate. The APR actually shows all the upfront costs that are associated with the loan transaction. So, your closing costs are going to be included in that. So let's say your actual rate is at, let's say today, maybe 5.5%. Your APR might show as 5.8, 5.9, which is something that people will usually ask because they're like, why is there a discrepancy? The interest rate is basically what it costs you to borrow money. And the APR just also includes everything that you paid up front, like maybe your appraisal or title fees. So there is a distinction, and it does confuse people a lot. But what's most important, in my opinion, is what your interest rate actually is for that mortgage. Again, closing costs, about 3 to 6% of the total loan amount. When we pull credit, we are looking at all 3 credit bureaus, and we get something called, it's called a tri-merge credit report. Shows us, Experian, Equifax, and what's the other one? TransUnion. So we'll see all 3 scores, and we're going to use basically the middle score to figure out what score qualifies for you to move forward with that loan application. Your debt to income ratio is basically just the difference of all of your income divided by all of your monthly expenses. So it's your monthly gross income and your monthly gross expenses. For your monthly expenses. We mentioned equity. Equity is, again, just the difference between what your house is worth and your current balance of that house or your mortgage. So it's just that difference. And I think somebody actually asked earlier about equity that I don't think I addressed.
I did. Can I add to equity? I just want to add to that you can actually purchase a home and have equity built in. And I think we're getting back to the phases where you're buying a property below what it's worth and you have that built-in equity. And I don't know, Sam, how long before you can actually tap into that, but it is nice, it's kind of like a steal, I guess, if you will, buying a property for less than it's worth.
Yeah, you can tap into it basically, essentially right away. We have people that pull out home equities. So someone asked or someone mentioned that equity is like another loan.
Mhm.
Mm, Not
Kinda.
necessarily. Again, equity is just the difference between your value and your balance on your mortgage. So that's the amount of money that you could potentially tap into. I think what you're maybe referring to is the home equity line of credit, which will be the type of loan you get that taps into that equity. Does that kind of make sense, guys? So that's just basically the type of loan is a home equity line of credit, or it could be even a cash out refinance. So equity isn't necessarily, it's not a loan. It's not a loan.
No, not alone. I didn't mean that. Yeah.
Okay.
Did Maureen have a question?
Yeah. Hey, Marie.
Hi, thank you very much for everything. So I have a question. Most of the times I've heard people saying you put 20% down payment and then you get a fixed 15. You ask for a 15-year fixed or something, forgotten the term. So what about if you don't have that 20%? Can you still ask for that fixed rate?
Yeah, you can go fixed rate either option, and you don't have to put down 20% for a 15-year term. So this is where it comes down to the individual and what you can afford. For the most part, another thing I like to ask also is this house going to be a long-term investment? If it's not going to be a long-term investment, then yeah, maybe the 15-year works. I'm sorry, the 30-year, because the 30 year is going to offer you the most flexibility. And of course, you know, the more you shorten your actual term, the more the more your monthly mortgage payment is. So if you're crunching $200,000 from 30 years to 15 years, you're doubling your payment. Is that something that you can afford? A lot of people like to do the 15-year because they're like, well, I'll be done with my loan sooner, which is great if you can afford it. Most people can't. And most people, like Jess said, they're not going to be in that house for 30 years. So just take the 30-year term, have a much more flexible monthly payment. And for the most part, that makes a lot more sense for people than doing the 15-year where you're not even going to own that property for more than, let's say, 5 or 10 years. So I always say go for the 30 because for the most part, it usually makes more sense. Now, the 15-year term is going to have maybe a slightly lower rate. So you are going to be paying less in interest. But for the most part, most individuals, it doesn't make sense to do a 15-year term unless you truly just want to get done with that mortgage payment as soon as possible. Yeah. So I don't, does that answer your question? Yeah, it doesn't have to be. You don't have to put down 20% to do 15 years.
It does, thank you.
All right. Again, gross income, that's just before taxes are deducted. Something that some lenders charge is points, or you can pay points to get a reduced interest rate. It's something that I don't typically, I actually looked at one today for a borrower, and they wanted to go from 5.2 to basically 3.375%. And that was going to cost them $23,000 to buy down. So if you have the funds and you want to do that to save yourself money down the road in interest, sure. But for the most part, it's not something that I recommend is to buy down the interest rates, because one thing that I like to say is marry the house, because that's the long-term investment, and date the rate. So we know the rate is not going to be permanent. There's individuals that I've helped that have done 3, 4, 5 refinances because they're trying to get the best rate. So like, let's say the past couple of years, rates have been in the 2s and 3s. Right now, rates might be a little higher from what we've been used to, but I wouldn't still I wouldn't pay anything down on points to get a slightly better rate, because it could cost you thousands of dollars. It may not necessarily make sense. So I think it's better off to, and again, 5.5 or 5.2 is not a terrible rate. I think it's just better off to necessarily, basically wait for another year or two to see what rates come down and refinance it. But it's one of those things for some people, it's just security. They'd rather pay it down now, they can afford it, and have that rate fixed for 30 years. So Totally comes down to the individual, not something that I recommend unless you do have access in cash. So just wanted to throw that out there. And another side note, some banks are actually charging points up front. So in order to get the rate they're advertising, they're already building in points. So that's something that you want to ask your lender to make sure you're not paying anything additional.
I was gonna add that too. I had a first-time home buyer that had a pre-approval letter when I met him, and he was looking in like a 4% interest rate when the average rates were about 5% or 6% at the time. And we took a look at his pre-approval letter, and there were, not the letter, but everything else that you provide them with.
Maybe the loan
and there
estimate.
were discount points, discount points included, and that increases your closing cost. Isn't that the closing cost amount?
Yep. You pay that
And
upfront.
he
in
did
closing.
not know that at all. So definitely, do your research. If you're not going to use Sam, do your research and make sure that you are using a trusted lender, because sometimes they will do things like this to get you the advertised rate.
And it's unfortunate because they're not transparent about it. Like even once you get your disclosures, a lot of times they don't know until they're halfway through the process. I had someone reach out to me, and just based on her situation, I knew what kind of rate she qualified for, and she told me another lender pre-approved her for a much lower rate. It was just in my head, it didn't make sense. So I asked her, I was like, hey, you might want to ask them if they charge you discount points. And sure enough, they did, and they didn't even tell her. It was like an additional $3,000 that she was paying that she had no idea about.
Yeah, that's crazy.
And come to find out, I was able to offer her the better rate without the points. So definitely, you want to make sure you're not overpaying. Every lender is going to be different. Every bank makes different profits on the transaction. So you want to definitely work with the best bank, or with the bank that's going to offer you the best rate with the lowest amount of fees. So I do recommend shopping around. I do want to make sure that every borrower is for sure getting the best rate. And I'll tell people, if there's something out there that's better than I can offer, I want to make sure that they're taken care of, because again, this is a long-term investment. So by all means, go with whoever's going to do right by you. With that being said, it's not often that I get beat on rates and fees. So another thing I want to talk about is pre-qualification and pre-approval. And just feel free to chime in, but for pre-qualification, it's essentially the lender taking your application, pulling credit, and just basing everything off of that initial application and your credit score. So they're not really digging deep on your actual income documents, which is very important. Because a lot of times people overestimate their income, and we have issues down the road once it gets to an underwriter. So that's something worth asking. And a lot of times for pre-approval, that's actually making it to an underwriter beforehand, and they're essentially approving the borrower for that loan. So there is a difference, and the pre-approval is going to be a much stronger, basically, certificate to help your offer get accepted.
Yes, and I guess I'll just add to that. Some sellers are okay with a pre-qualification letter, but obviously the pre-approval letter is preferred, but some sellers will not accept your offer if you give them a pre-qualification letter. They want to know that for sure someone has taken a look at your financial situation and looked a little bit deeper. So that's something we always require as real estate agents, making sure you have your pre-approval letter, or at least a pre-qualification letter. I know, Sam, you give me pre-qualification letters, but Sam always closes his loan. So, but it's definitely a preference to have the pre-approval letter. It's definitely a requirement. So
and that's the quickest way.
Consider.
Yeah, the quickest way to get something out is typically a pre-qualification. But yeah, me personally, I do my due diligence, and there is a compliance issue when it comes to that. So technically, it is supposed to make it to underwriting, which is why a lot of lenders don't necessarily want to give out pre-approval, because you're basically putting more people to work, and we don't even have a deal that we know is closed. If that kind of makes sense. So, all right. So the next thing we kind of mentioned earlier is the PITI. So that is how your mortgage payment is essentially broken down. So when you get a mortgage, and let's say the listing price is $200,000, and let's just say you get 100% financing. The principal is that original loan amount, right? the interest is the amount you're paying to borrow that money. So let's say today the rate is at 5%. That's your interest, right? So that's gonna be broken down monthly. You're gonna also have additional payments for that property that goes to your local taxes. So every county is gonna have their own taxes for that property. That's something that we have to factor in. Depending on whether or not you do escrow, which most people do, it's easier for us to do it that way for borrowers. That way you don't have to save money separately to make sure you pay your taxes or insurance, because that's also can be a very hefty burden. So, if your tax bill is $3,000 and you're paying it on your own, are you going to for sure have that money saved up to pay it, towards the end of the year? Or would you rather have that included within your monthly payment? And then you can also have insurance. So this is separate from your mortgage insurance. So this is your homeowner's insurance, which protects you, the buyer of your property. So, again, like the flooding, or if there's hail or anything like that, or there's a fire, your homeowner insurance, which we require you to have because we want to make sure that your asset is protected. And of course, our loan is protected. So we want to make sure that the house is definitely insured. So that is what makes up or comprises your monthly, or I'm sorry, your mortgage payment. Do we have any questions on that? All right, so one of the biggest factors is credit. And this is the way, can you guys see this?
Yep.
Yeah.
So this is basically the way that the credit bureaus grade your credit score. So there's a bunch of different factors that they look at. The most important things are the amount of money that you owe on each credit line and your payment history. So whether or not you're making your payments on time. So those two things are very, very important. So typically you want to have your amounts under 30% usage. So let's say you have a credit card with $1,000 credit limit. Make sure that balance is around $300, essentially, for it to be basically a great score. A lot of times we notice that a lot of people are overutilizing their credit. So they're having, their credit card is basically maxed out. And with that area being heavily weighed, that's going to have a huge impact on what your actual credit score is. And of course, making all your payments on time. So these two things are going to be the bulk of your credit score. The other ones are not as impactful. So you got your credit mix. So that's the type of credit lines you have out there. So credit cards, personal loans, car loans, they do like to see a mix of different credit lines that are open, rather than just having, let's say, one credit card open. Your credit history. So that's basically how long you've had that line of credit open. This is pretty important as well. So one thing I recommend is a lot of times people will have credit cards they've had open for years, and let's say you have a $0 balance. I would always recommend to keep those lines open because it carries that history with it. And as soon as you close it, that history goes away. So I always recommend that people keep those cards open. And then new credit. So this is anytime you get inquiries. So anytime let's say you apply for a mortgage, you apply for a car, you get, credit card, or you apply for a personal loan, anytime a creditor checks your credit, reports your credit, they call that an inquiry. And typically it's going to be a hard inquiry. I don't know too many people that do a soft inquiry other than maybe insurance. And a soft inquiry basically has no impact on your credit. But most people are going to pull a hard credit inquiry, and that's going to have an impact on your score as well. They want to see less inquiries on your credit report. And then we have our matrix here. These are the items that are going to they're going to also have an impact on your credit report that we look at. So, and also shows how long they last on your credit. So your hard inquiries fall off in your credit every 2 years. So it's best, honestly, to not have your credit looked at more than, I'd say, a couple times a year. And since we're on that subject, so when I mentioned earlier shopping around, the credit bureaus are very, very lenient. It's basically called like smart shopping. So if they know you're looking for a house or you're shopping for a car, basically so long as it's done in a 30-day window, those additional inquiries are pretty much equivalent to that first inquiry. Does that make sense? So they allow you to shop around to where those other inquiries don't have an impact on your credit score. Only that first one does. But again, keep in mind that's for the first 30 days. And that's usually only with mortgages and car loans. So just want to throw that out there. The rest of these are very, very huge impacts on your credit. So delinquent payments and defaulted accounts. So basically delinquent payments is when you make a late payment, right? So you miss your credit card payment, and typically with that, it's a 30-day period. So if you miss let's say your credit payment is due, your credit card payment is due today on the 28th. If you make it on the 30th, that's not going to report late to credit. Now, your credit card company might charge you a fee for being late, but they typically don't report to the credit bureaus as a late payment unless you're 30 days late. So just want to throw that out there. So, because a lot of times people call in and they're like, hey, I missed my payment by a day. The good thing about mortgages is you do have a 15-day grace period. So you have at least 15 days to make a payment without getting charged a fee. But even outside of that, you basically have 30 days before it gets reported to the credit bureaus. A defaulted account is when you pretty much have missed several payments to where the lender is like, you know what, you're no longer meeting the terms of our agreement. You pretty much owe our entire balance at once. And that's when it essentially goes to pretty much collections at that point. So you pretty much are done with that loan and you have to pretty much pay it off right away. So that's once you've missed several payments and you're in a delinquent status. But both of those stay on your credit report for 7 years. So even if you get things corrected, that's still going to reflect on your history. Foreclosure, also 7 years. So kind of pretty much default on your mortgage payment. Sorry, the question just came in. So someone asked if one has a stored credit card and wants to cancel it, will it affect their credit score? Yeah, it will. So again, I don't recommend closing out any cards. Sometimes when you don't use a card for so long, the creditor will go ahead and close that account for you. But I do not recommend closing out any types of credit loans. Now, if you know you're not going to be applying for anything down the road, and even if you do, I don't want to scare you guys. Like, it's not going to be a huge impact. It might cost you, a few points, but it is going to still have a negative impact on your credit. So just wanted to put that out there because everything reflects your overall history. So if you have a credit card with, let's say, Gap, and you've made timely payments on it for the past 5 years, even though you have a $0 balance, why close that out? Now you're getting rid of all that good history. Does that kind of make sense? So I would not recommend you close out any lines of credits unless you feel like you absolutely have to. Maybe you feel like you may be irresponsible. Oh yeah. There's an annual fee. Okay, that makes sense. To lose a few points on a card that you're not using that's charging you an annual fee, that makes sense to close out. So yeah. But just know it's probably still going to have an impact on your credit, but totally makes sense in that scenario to close it out if you're not using it. So does that answer your question, Eunice? It will. Yep.
Mm-hmm.
It still will have an impact. Yeah. What the creditor charges you for having that line of credit is basically an agreement between you and Capital One or whoever that creditor is. That has nothing to do really with the credit bureau. The credit bureau is basically just an entity that records all of your credit. Cool. All right. Hopefully this is helpful and gives you a good idea of how your credit score is graded. I do recommend reviewing your credit report at least once a year. For me, it's actually more frequent. I look at it every month, essentially, sometimes a few times a month, just to make sure there aren't any inaccuracies. So sometimes I see people have their names misspelled. Sometimes I see people have, a credit card that maybe is, their twin brother that's not theirs. You want to make sure that everything that reports in your credit report is accurate. Let's say maybe you had an item that you had taken care of and the creditor still has it reported that you owe them money. That's something that you want to get taken care of because that has an impact on your credit. So make sure everything's accurate. So you can review your credit report for free on freeannualcreditreport.com. But of course, you have other sources like Credit Karma. Another one that I like to recommend is Experian. So they'll actually show you basically your free credit report, your free FICO score that we actually use as a mortgager for free. So, and yeah, it's actually coming directly from the credit bureau. Whereas if you're doing Credit Karma, yeah, they partner with credit bureaus, but they're also looking at the Vantage score, which is a different type of grading system than the FICO, which is what we use when we look at your credit. So this kind of goes over what I just went over, so I'm gonna skip this. All right, so tips for managing your credit. So of course, limit the number of credit lines. So that kind of goes back to also those inquiries. So every time you open up a new line of credit, that's a new inquiry. And the credit bureaus don't want to see that you have 20 credit cards. So it just doesn't make sense. So definitely limit the number of, for me personally, I have my Prime credit card that I use for pretty much everyday purchases. And I have my own reasons. I get points on it. It's basically for me free money. And I'd rather use, and it's also security. So this is outside of mortgage, but using your debit card, that is directly tied to your checking account. So if you have any type of, someone steals your credit, or I'm sorry, your debit card, it can essentially have access to your cash. Now, sure, you can file a dispute with your bank. That's just a really big hassle, in my opinion, rather than them tapping, Capital One's money. That's their money, not mine. So it's much easier to sort that out rather than having, my debit card compromised. And again, credit cards will offer you also, points or rewards, which, again, in my opinion, is essentially free so long as you're making your payments on a monthly, timely monthly manner. So you're not paying any additional interest by making timely payments on your credit card. So that's just something to keep in mind. So yeah, stay below your credit limit. So again, the rule of thumb is essentially 30%. So under 30% of usage. Pay what you owe, pay attention to the payment due dates. Also, a side note, the credit cards or the creditors are going to usually report when it comes to credit cards on your statement cycle, which is usually a little different from your actual due date. So I recommend paying it off by your statement cycle rather than your actual due date. That way, when it actually reflects on credit, it's going to show you that you have a $0 payment, or I'm sorry, $0 balance, which has, of course, the best impact on your credit. So that's just something to keep in mind. But of course, paying about a due date is also important because now you don't have to worry about any interest. Keep your contact information current because sometimes, again, they'll reach out to you if maybe something has been compromised and needs to be addressed. So that's something I used to be bad at, was not updating my contact information with my creditors. So make sure that's, I know a lot of times you guys want to avoid maybe spam or anything like that, or marketing material getting mailed out to you, but it really is important that they have your right contact information. And you can also opt out of those marketing material too. So just keep that in mind. Having an emergency fund so you're not constantly relying on your credit cards to pay your bills or to feed you. So it's always good to have money in your savings account and not rely wholly on credit. Keeping credit lines minimum, so kind of similar as limiting your number of credit lines. Right. So what can I afford? Let me see if I can get this added. We're getting pretty close to wrapping up here, guys. Let me know if you have any questions. I'm going to add something to the chat. So this kind of goes over what I look at. And again, they're using 38% for the ETI, which is very conservative. I'm going to be using 45%. So there's a worksheet there that you guys can use to figure out how much you qualify for on a monthly mortgage payment amount. But I have one with an example already. All right, so in this situation, the buyer makes $70,000 annually. So when we're looking at that debt to income ratio, we're looking at everything from a monthly perspective. So we want to see what your actual monthly payment is and what your monthly debt obligations are. So you're going to take that 70,000 annual salary or income, and then you're going to basically divide that by 12, and that's going to give you, your monthly income. So you're going to take that monthly income and you're going to multiply that by 45%, and that shows you the maximum amount of debt you can have to qualify. Are you guys following along?
Yeah.
Cool. And it does show other things here that we can address later, or if you guys have questions. Bonus and overtime, we have to be careful with that. So as a lender, we can't always use that unless we show that you've been receiving it for at least 2 years. We look at that as essentially non-guaranteed income. So that's going to, or variable income. So that's going to vary. And we don't necessarily want to rely on that unless we know that you're going to continue to receive that. And that's going to be based off of your prior history. So sometimes people in their application will put in their bonus. They've only been receiving bonus overtime for the past few months. We can't use that. We don't know if that's going to continue to come in. There's other income, there's child support and alimony. So if this is something you receive, we can use that, but we do have to essentially document that you're going to be receiving that for the next 3 years. So just to keep it simple, I just use the standard income. So take that, get the monthly amount, multiply that by 45%. That's your maximum debt. And then when we're looking at debts, for credit cards, we are looking at your actual minimum monthly payment. So in this situation, let's say I have, 2 credit cards, and overall monthly, I have a minimum payment of $500. And that's what reports to the credit bureaus. Now, if you're making additional payments, if you're paying off the full balance, that's great. But from a lender perspective, we're just looking at that minimum, what's required to be paid. And that usually helps out the scenario much better than, well, I'll make my full payment, which is $3,000 a month. Yeah, we don't want to use that full $3,000 because now you're not going to qualify for anything. So in this situation, we have $500 in credit card payments. We have $375 in your monthly car note. Let's say $200 a month in student loans. And now you have your gross monthly debt at $1,075, which is under that maximum debt of $2,624, which keeps you underneath 45% debt to income ratio. And all you're doing is basically subtracting the monthly debt from the maximum debt. And that is the maximum mortgage payment you will qualify for that keeps you at that 45%. So in today's market, that would essentially be a $250,000 loan at, let's say, 5 1/4, 30 years, which is a $1,300 payment. Does that kind of make sense, guys?
Yeah.
Yes.
Perfect. So feel free to plug in your income. If you have additional income, you can document that you're going to be receiving that. So sometimes we'll have to look at maybe a divorce decree or whatever your court document shows. So long as we know that that's coming in for 3 years, we can use it. And if you've been receiving overtime for the past 2 years, we can also include that. But what we're going to do is, side note, is we're going to average that overtime from the previous 2 years. So we're going to look at your end of year pay stub, like for now, 2020 and 2021. We're going to total that up, and we're going to basically divide it by 24 months. And that's going to be the amount we can use monthly. So I know a lot of information there, but for the basic, this is how we calculate how much you qualify for in a mortgage. So again, you guys have your own sheet there. Feel free to print that and use it to figure out what you can afford. All right, so steps to choosing your home. Of course, know your budget. Don't get emotionally attached. I'm sure Jess can attest to that, where it's been very, very insane these past couple of years. You're not going to always get your offer accepted. You might have to be patient. You might have to wait. You might have to make multiple offers. But just know that so long as you have a game plan and you stick to it, we're going to help you get into a house. Of course, do your research. That also comes down to, researching your loan officer, researching your real estate agent, researching obviously whether or not you qualify, making sure you have your down payment money together. Think ahead, do you have a lease coming due in the next year, and you want to make sure, or the next 6 months, and you want to make sure you're qualified and ready to go and move out before your lease is due, because you don't want to break your lease and pay extra money. Look at more than the house. So I think that goes back to maybe Jess's arena, is the house in the right school district? Is there a nearby gym that you like to visit? Is it centrally located? Can you easily, visit friends and family where you live? Or can they easily visit you? These are other things that you can, you may want to consider in choosing the right house. So other than that, we're basically wrapped up. So I'll leave it open to any questions that you guys have. And Jess, if there's anything else you wanted to add, feel free to add it.
Is it still a seller's market?
That's all you, Jess.
It is still considered a seller's market, but I will say in this last month alone, I have had 2 clients get their closing costs paid for. So it is slowly transitioning. Some properties are still getting multiple offers, so that's why it's still a seller's market. But certain areas, buyers have dropped off because of the high interest rates, making it they can't afford the mortgage anymore. So I think it's still a seller's market, but depending on which agent you work with, you might be able to get your closing costs covered, and you might be able to get in there early and get your offer accepted. So it's definitely starting to switch.
Yep. Now I've even experienced it on my side. Rates, I've seen rates as low as on 30-year, 2.75%, which is insane. So we've had some historically low rates, and that was part of the reason why things were so busy these past couple of years. Of course, you had COVID too, which had an impact on rates, and that also had an impact on where people could work. So some people were able to actually relocate and still work for the same employer. And, those factors really drove up demand, and everyone wanted to buy a house. Prices were just absurd. But yeah, so things are kind of slowly transitioning back to a buyer's market, but it is still a seller's market. We're getting there. I actually had someone today that couldn't afford the mortgage payment anymore because now the payment went up by about $300. So yeah, people are pulling out because rates are higher than they were last year. So
yeah. Well, I felt like that was a lot of information, Sam. I think you really touched on everything, but I think overall what I would say is just the plan in advance. It does make it a lot smoother once you start shopping, because you can find your house, like your dream home, the first day. And if you're not planning in advance, it can be really stressful for you. So definitely plan in advance.
yep, yeah, and I have people that I've worked with months ago that may have not met the credit requirements or may have not had the down payment money together. And that's something that we've been working on, is rebuilding that credit and having money saved up so that they are ready to go. So again, this is, like I mentioned earlier, one of the biggest investments that you can purchase. And you want to make sure that you're prepared and you have all the necessary information to make the right decision. So again, to wrap up, I just want to thank you guys for hopping on here on Thursday evening and spending some time with us. And I hope that you guys got some valuable information. I do encourage you guys to reach out to us if you have any additional questions or things that are more specific to you and your scenario. And we can definitely have a conversation with you guys and get a game plan on what we need to do to get you into a house. So again, any additional questions? I did type in my contact information. Jess, I don't know if you want to add it into chat so they can reach out.
Yeah, I'll go ahead and I'll add it in there.
And I'll pass it back to Jeffrey. I don't know if you have anything to add, Jeff.
No, thank you so much, Sam and Jess, I think that was a very, very, very helpful information. Personally, I have learned a lot. I think I felt like I was actually in the classroom, and I was actually taking some notes and a couple of screenshots, so I can be able to review some notes later. I feel the same. I hope many of them also who are in the audience were able to take some information, and hopefully for those who are interested or planning to get a home, we always say that this is not just for the people who are ready to qualify to get a home, or those who have been in the country for a long time. We always encourage even those who are very new in the country to start with this information, because so many a times people make mistakes, and by the time they get to the information, they're like, oh, nobody told me this. If I knew this, I would have done it different. So we appreciate you guys for, I really see that you are really prepared, and not just to get people to buy a home, but also to help them to work on their finances and manage their finances well. Because the bottom line here is to make people that are more financially independent, and helping them make right decisions when it comes to finances and managing their finances. It's good. I wish I hope that when you call you back again, we'll be able to do more, because this was a really financial literacy, I'll say, big time. And I think we can continue doing this and learning more. One thing I'll say for the purpose of people listening is that Midwest Bank is actually reaching out and purposely, intentionally reaching out to the minority, the immigrants, the refugees, and helping them address some of those barriers that they face when it comes to the access to finances, and also maybe them understanding the unique challenges that we have as immigrants. And I would say take advantage of that. Go to any branch that is near you. I know in Hazelwood, we have a branch there. You can not necessarily look for mortgage if you're not ready yet, but you can open an account and start building your relationship with the bank early. I would want to see and continue building the relationship with the bank that really understands us. And I see that's what Midwest is doing. And I hope that my fellow Africans will be able to see, build, because we have, when you're many, then we can always have a way to negotiate ourselves. And I think that's why we want to also build relationship with the bank, build relationship with the lenders, and also those who are buying houses. Like now we have Jesse. Those people who are buying homes, they can have somebody they know, and they can talk to you and tell you some of the things that they can ask questions that you cannot ask. They can tell you things that you don't know. So let's continue with this conversation. If you're here and you have some information you have learned, be generous and share with your friends. We'll try to share also the recorded part of this, and hopefully we can continue having more conversation to enlighten our community, to empower each other. Other than that, I say thank you so much. I see Solomon, thank you so much for your job and helping us with the mute. And also Sally, I appreciate you all. Seb, thank you so much. But everyone who's been here, it's we're almost heading to 2 hours. But I really appreciate that you guys were able to stick around and take notes and take all the information. It's a time that is worth your investments. We hope that we will invite you again for another conversation. And when we call Sam and Jess, I hope it's going to be a yes.
Yes, absolutely. I love to help everyone. We all should own a home eventually.
And I definitely value our partnership, Jeffrey, and I do plan on holding more of these workshops on a monthly basis. Hopefully, maybe maybe in live person next time, or in person next time. I think that would be very helpful. And we can also, dig deeper into specific loan programs, because we didn't really get a chance to dig into that. So I think that would be very helpful. And again, I did share my cell phone number. So, that's my personal line. So reach out to me whenever, shoot me a text, call me, shoot me an email, and I'll reach out to you.
Great. And I think for those who are in the audience, Sam and Jess have shared their contacts on the chat. You can know them, and then that means they are free to respond to you on one-on-one if you're able to reach out. And that's it. We appreciate you for your generosity, guys.
I'm also wondering whether there is a place for review. It's a 6-star from me.
Oh, well, we appreciate that. Not really, but I'll take it. I'll take the verbal review. No, we really appreciate that.
Okay.
Good. Maybe Sam, Solomon, if you have something, you can wrap it up, and then we will call it a day. All right.
I think that's all, Captain. Thank you so much for giving us the platform as our community leader. It's indeed a milestone for us, and for Sam and Jesse, as we navigate through this, of course, you'll be part of us as you are part of us.
Thank you guys so much for having me. I really, my pleasure. That's all I have. Thank you so much for having me.
Great. Thank you so much. Everyone, have a good night. I think we'll have another session next Thursday. I'll get all of the details for our different topics, but I'll share on the chat on the emails later. Thank you so much, and have a good night.
Awesome.
Thank you.
Good night.
Thank you.
Bye.
Good night.
All right.